Investors' concerns, of course, are mounting with President Trump escalating insults towards Fed Chair Jerome Powell. He once again called on the Fed to cut interest rates, and this coming after Trump last week threatened to oust the Federal Reserve Chairman. Here with more on the rising risks, we have Apollo Global Management Chief Economist Torsten Sløk. Apollo Global, we should mention, is the parent company of Yahoo. Torsten, fantastic to see you, as always. Man, we got a lot to weigh these days in terms of potential risks to the economy, whether it's tariffs, some of the other geopolitical things going on, and now layer this potential threat about a removal of the Fed chair on top of it. As you're trying to weigh all of these risks, where do you put the risk that Jay Powell would be removed in terms of what that would do to the markets and the economy?
Well, first of all, thanks for having me, Julia and Josh. It's great to be here. So I think that the first immediate risk really is the impact of tariffs, especially the tariffs on China. We all agree that there is probably a need in some form or another to level the playing field with China. Democrats, Republicans have talked about that for a long time. And it is clear that the U.S., as the most open economy when it comes to tariffs, when it comes to non-tariff barriers, continues to, for years and years, have been open for the rest of the world. So the goal of trying to level set tariffs and level set global trade is something that I think really there's broad consensus is everyone agrees is a good idea. But the way that this has been implemented by imposing from one day to the other 145% tariffs on companies have, of course, meant that those companies that import goods from China, for example, your independent toy seller in Nebraska, your menswear store in Wyoming, your company that is selling, say, goggles and board ski gear equipment in Colorado, they suddenly from one day to the other do not have the working capital to pay 145% more in tariffs. And that's why a lot of retailers, such as those I just listed, are likely going to go out of business if these policies continue. So to answer your question, Julie, I think that the problem is that the immediate risk is that small businesses are at risk of potentially being hit quite hard because small businesses make up 80% of employment and 80% of CapEx spending. And that means that, yes, there are other risks, and certainly the threats to Jay Powell is another important development more recently, but the most immediate risk for the business cycle is the impact of tariffs on the small business world.
You say, Torsten, in a note recently, you say there's now a 90% chance of what you call a VTRR. Explain what you mean by that, Torsten.
Yeah, so if we really back up and think about normally, the economy is constantly faced with all kinds of what you could describe as shocks. For example, it was a shock that COVID came along. That created a recession. It was a shock when Lehman Brothers went under. That was a recession. We also had a shock in the early 1990s, of course, with the commercial real estate crisis. And we had a shock in 2000 when the IT bubble popped. So what is the shock today? Well, the shock today really is a voluntary trade reset recession. In other words, from one day to the other, a politician got elected. He comes in and says, I would like to start a trade war. And this trade war is now implemented in a way where we in financial markets can only conclude that it comes with more downside risks than if it was implemented in other ways. And it is mainly the implementation that is the biggest challenge when it comes to the economic outlook, namely that it comes with the risk that there is a requirement that, for example, your retailer who sells toys in the Midwest, who is now an independent store that normally has been importing from China and now needs to find other ways of getting these toys. And there is no easy, quick way to do that because the same toys are not produced in the US. The same toys might not even produced in other countries. 75% of toys that are sold in the US, they come from China. So the conclusion is that the way that this unfortunately has been implemented is going to have a more negative consequences. And that is what we will call a voluntary trade reset recession. In other words, it's voluntary, it's a trade reset, and we are worried that there's a 90% chance now that this is going to result in a recession if these tariffs stay at these levels.
Torsten, what do you make of the argument about what the administration is trying to achieve in the end in terms of, as you say, they are resetting the trade paradigm on purpose? Is what they're aiming to do, A, is it achievable? And B, is it worth achieving?
Well, one important aspect, of course, is the discussion around the manufacturing sector only makes up today around 10% of U.S. employment and 10% of GDP. It's been declining over the last many decades from around 40, 50%, if you go back to World War II, to now making up a much smaller share of the economy. So if the goal is to increase the manufacturing sector, then depreciating the dollar, of course, comes with another set of risks, as we, of course, are talking about in markets today. So the question here is it possible to grow the manufacturing sector? And if we want to grow the manufacturing sector, is that coming then with enough value added? For example, producing large language models, producing AI, of course, has more value added embedded relative to producing T-shirts and shoes and toys, etc. So there is some very fundamental questions around if you grow the manufacturing sector, and that is definitely possible, but is the cost that has to be paid to achieve that goal going to be significant in terms of what it might mean for labor that could otherwise have been spending hours inventing large language models, again, in AI and technology. So to your question, Julie, yes, it is a very important part of this discussion to debate whether the goal is to increase manufacturing and if it's possible and desirable to increase the manufacturing sector. And if so, what type of products is it that we are imagining should be produced in the factories that potentially has to be built in this country?
Torsten, when the president went after Powell on social media, he did also talk about, of course, preemptive cuts by the Fed. I'm just curious what you make of that.
Yeah, so the challenge for the Fed is, of course, the following, namely that the Fed has a dual mandate. On the one side, they need to make sure inflation is 2%. On the other side, they need to make sure that growth is around 2%. And now with a trade war, we, of course, have that inflation is going to go up because tariffs makes things we buy in the U.S. more expensive, and estimates from the Tax Foundation, the Peterson Institute, also from the Yale Budget Lab, point to inflation over the next 12 months going up about 1 percentage point. So if inflation is going up, the Fed should be hiking. But if at the same time growth is slowing, the Fed should be cutting. So which side of the dual mandate should you put weight on? And that's why this debate around what should the Fed do is so important, because the risk, of course, is that inflation is about to move higher because of tariffs. But if growth in the next several weeks, we could see potentially stores, including here in Manhattan, that will run out of goods that are no longer being imported from China. We could see supply chains getting clogged up. We could see, of course, a slowdown in tourism. We could also see inflation begin to move higher. So if growth is slowing and inflation is moving up, then the Fed will need to decide, is it time then to begin to cut interest rates? And they are saying in that dot plot that the next move is a cut. But the debate, of course, in markets is how quickly should they do that at the moment, especially now that the dual mandate is pointing in opposite directions.
Well, and the president has made clear where he stands on the issue. He seems to think the Fed should be doing it now, right, or yesterday, or as soon as possible. The market in the first Trump presidency and even now sort of struggles with how seriously to take the president's various threats when it comes to things that affect markets and the economy. So I guess I would circle back to where we started, this question of how real is the risk that Jay Powell could be removed, or at least that there would be a fight to remove him. And I'm curious how seriously you're weighing this and how you even go about weighing it.
Well, there is one important point also here. Let's not forget that Jay Powell's term runs out in May of 2026. There's another FOMC member, Adriana Kugler, who will have to step down in January 2026. So we will probably, in any case, in the next 3 to 6 months, figure out who the next Fed chair is. So yes, of course, this debate is very serious about removing a Fed chair. That basically never happens really anywhere in the OECD area. But this debate is already getting to another point where, well, if we just wait another 3-6 months, then the Fed chair will already have to come to the conclusion that he is stepping down in May of next year, and we need to appoint someone else. So that's why markets, of course, need to figure out whether the firing of Jay Powell is an immediate risk or whether there is also a scenario, well, maybe we should just wait another, again, 3 to 6 months. And then we will, in any case, have a discussion around who the next Fed chair should be.